of go ahead and do a round of forensic accounting to make sure that the 10-12 forensic checks that we have, the company basically passes all those checks. Yeah. So I think Gaurav has already sent you the YouTube link on the chat for the first session. So we record every session. So you guys can, Bhavna has already heard it, and even the others have already heard it. But Rishikesh and Kunal, you both can, go through that link first. And then this is the second part of it. This will also be recorded and made available. Yeah. And while listening to the video, one tip which I use myself is if you find that I'm talking, slowly and you can consume the content faster, you can increase the speed on YouTube to 1.25x and listen. So I often do that depending on how fast the speaker is talking. So if it helps you guys, you can try that out to save some time. Yeah. Any questions, Rishikesh, Kunal, before I start presenting? I'll start off from where I left off. So yeah, any questions?
No, sir.
Okay. And Kunal, don't call me sir. Huh? Call me
Okay.
Nirvan. Call me by my name.
Okay.
Rishikesh, we can start.
Yes, sir.
Okay. Sir मत बोलो यार.
First
Sorry.
name,
Yeah.
आदत
Nirvan
है.
बोला करो. Yeah. So let me present. Yeah. So just a quick refresher, guys. I think Bhavna, you will remember. So some of the things that we covered was how to check whether management has skin in the game. Look at promoter ownership as percentage of net worth, pledged shares. And the second aspect was, is the board independent and does the board have autonomy? So here, check the number of independent directors on the board. Check whether the audit committee is headed by an independent director. Check whether the board members have relevant experience, whether their experience can actually help in guiding the company's management, or they are there just because the management knows them or the promoter knows them, etc. Then you look at auditor quality and what opinion the auditor has given. Is the auditor a large, well-known firm? Has the auditor provided a clean report or not? Is auditor remuneration in line with companies of similar size? Is the company paying too much to the auditor compared to other companies that have similar complexity? Is the auditor payment growing faster than the revenues? Yeah. So because one way that frauds have been caught in the past is when auditors have been paid a lot, it means that the auditor is being made to hide certain things in the numbers, for which the auditor has to work harder and therefore he is paid more. So that's why this check is done. Yeah. Uh, are the subsidiaries of the company audited or not? Yeah. The next very, very important is cash generation. So our profits are great, but is cash generation happening or not? Yeah. So over a 3 year or 5 year period, how efficiently is the company converting EBITDA to cash flow from operations? Yeah. Does the interest earned on cash and cash equivalents reported on the books make sense? So if a company is saying I have 500 crore cash on in different bank accounts, then the accounts will also earn interest, right? So that interest should be reported under other income in the profit and loss statement. So you can do a quick check कि 500 crore पे अगर whatever interest can't be lower than 3%, 4%, right? If it's in Indian bank accounts. So if you multiply 500 crore by 3%, at least 15 crores of interest should be reported in other income. If there is 500 crore of cash on the balance sheet but zero interest reported, then your Sherlock Holmes in your head should start firing. Yeah, कि ये क्या हो रहा है? Sherlock Holmes या Byomkesh Bakshi, whichever you like, should start firing. कि ये नहीं हो सकता, कैश भी है बट इंटरेस्ट भी नहीं है, तो that's the check. Yeah. So this is what we had covered till then.
Nirvan, we did not
Yeah, bro.
cover point four, isn't it?
I think we did. We didn't, is it?
No, no, no.
No, we did it till 3.
Oh, okay. Great. Then let's do it in more detail. Gaurav, have any of the other three people joined?
So Radhe and Pranav said they won't join, and
Okay.
Shantanu, I'm not sure. But anyways,
Mhm.
they'll get the recording.
Okay, cool. So
Yeah.
I'll go ahead. No, I just asked because I know who to ask questions. So yeah, cool. So cash generation and interest on cash on books. Yeah. So this is So this first point I think is pretty well known. At least Bhavna, we have spoken about this multiple times. So we need to check whether the EBITDA that is being reported on the profit and loss statement, whether that is converting to cash flow from operations or not. Yeah. So, Rishikesh, I assume you are aware of these terms, right? EBITDA, CFO, etc.
Yes.
Yeah. And Kunal, what about you? How is your comfort with these terms?
Yeah, I also know.
Okay, great, great. So basically, one thing that I've already told Bhavna and all the others is a new analyst will always look at the profit and loss statement first and get excited or get disappointed by it. An experienced analyst will look at the profit and loss statement last. He or she will first look at the balance sheet, then he or she will look at the cash flow statement, and then finally they will look at the profit and loss statement. Yeah, because profit is only on books, but cash is king. Without cash, the company cannot survive. Yeah. So the example that I like to give is, suppose there is a small pan shop, okay, and the pan shop is doing great business. It is selling 1,000 pans a day, okay. Every pan he's charging 50 rupees. He's selling chocolate pan, ice pan, fire pan, whatnot. But he sells them all on credit, okay. So he doesn't take money. He sells them all on credit. So Kunal, is this a good quality business? He's doing 1 lakh rupees a day of business, but he's not collecting cash. He's saying, ठीक है खाते में लिखवा दो, बाद में pay कर देना. What do you think about the quality of this business?
Bad quality of business
Why?
because he's not generating the cash.
Absolutely. तो
He's
कल अगर उसके पास कैश कुछ है नहीं, उसने इतना सेल कर दिया, कल उसको पान मसाला खरीदना पड़ेगा या पान के पत्ते खरीदने पड़ेंगे, तो उसके पास कैश नहीं होगा ना.
yes.
So basically, cash is everything for the business to survive and for the business to thrive. And later on, when we do valuations, you will realize that there is something called a DCF, discounted cash flow valuation. And the value of a firm is determined by how much free cash flow the firm generates in the future. Yeah. So cash flow is not only important for its survival right now, it's also extremely important to calculate the value of the company's stock. Yeah. So that's why, one of the first things that you should do is quickly check how well is this company converting its EBITDA or converting its PAT, profit after tax, into CFO. Yeah. And the best way to do it is to add up the CFO over a 3-year period or a 5-year period and divide by the sum of EBITDA over a 3-year period or a 5-year period. Because in a particular year, CFO can be too less, can be too high, but over 3-year, 5-year, it will reflect the inherent business quality. Okay. So this is one check that you should definitely do. And if the CFO to EBITDA ratio is greater than 1, then it's an excellently good cash converting machine. Okay. But if the ratio is less than 0.5, then you have to be a little worried. Yeah. And one more thing is that certain industries will be poor cash generating industries. Okay. So you can't really compare two companies from different industries and then say one company is better than the other in terms of cash generation. So everything that I'm talking about, you have to compare apples to apples. Yeah. So two companies from the same industry you have to compare. If one company is doing a great ratio and the other is doing a really poor ratio, that is less than 0.5 or something like that, then you have to be worried about the second company. Uh, any of you, Kunal or yeah, Gaurav, you're saying something?
No, no, please continue. Then I have a question actually.
Okay, sure. So Kunal or Rishikesh, one of you two, can you give me an example of an industry or a sector where the cash generation may not be so good? Where, yeah,
Mm, Might be in steel industry or something like that,
okay. Why do
uh,
you think so?
since their work means they are selling it on credit.
Okay,
Steel is being sold to like automobile
right,
industry, and
right,
so they must be paying after 30 days or 45 days or so.
right, right. Fair enough. Good attempt, Rishikesh. That is one industry where it will be a problem. So, Kunal, anything comes to your mind?
Yeah, the industries which are making government bridges and all.
Absolutely. Great answer, Kunal. You said what? Government bridges.
I mean bridges all.
Right. So infrastructure companies, you're saying,
Yes,
right?
yes. Infrastructure.
So bang on answer. So that's the first sector that comes to my mind. In general, any company that is doing business with the government will always have very high receivables. Okay. So it will the government doesn't pay on time. Government अपना time लेगा 100 दिन 150 दिन बाद payment करेगा. So there are three elements broadly to cash generation. Okay. I am diverting a little bit, Bhavna. This may be a little bit of repetition for you, but bear with me. So one side is receivables. How fast are you getting cash for the sales you're making? Okay. Then the second item is inventory. Uh, how many months worth of days worth of inventory do you have to keep? You know, if you're selling 100 in a year, do you always have to keep 100 with you in stock, or can you make do with 20 in stock and you can sell 100 in a year? That is another aspect. And the third is payables. How soon do you have to pay your suppliers? So just like you're collecting money from your customers, your supplier will want to collect money from you. So do you have the power or do you have the leverage to actually delay that payment? That helps you in generating cash faster, right? So there's a video that we have recorded on working capital and cash conversion cycle. Gaurav will share all. Actually, Gaurav will just share the link for the YouTube channel where all these videos are there. I would strongly recommend both of you to, quickly on 1.25x go through all of these. And whichever video you think is more complicated, needs more time, you can slow it down and go through them. But in general, you can go through them fast. Yeah, Gaurav, you had your question.
So, so my question is, when you talk about CFO upon EBITDA, which is greater than one,
Hmm.
see, I want to understand what sort of business is it? I mean, is it like uh, you have your revenues and your cogs are very low, or whatever cogs you create? I mean, uh, cogs and SG&A. After that, you have your earnings, right?
Right,
After your earning, that's your EBITDA, isn't it?
right.
That is your EBITDA. So basically, the company is. I'm not able to think in terms of cash flow from operation more
Yeah.
than EBITDA. How do you
Yeah,
process it?
so basically, see, when you're coming down to EBITDA, you're subtracting COGS, you're subtracting all your operating expenditures, right? You're subtracting salaries, you're
Hmm,
subtracting fixed costs, your factory running costs, etc., etc. Okay,
hmm, hmm,
and generally the largest item in here is for manufacturing companies, the largest item usually is COGS.
hmm,
Okay, in till EBITDA. Okay, then there is huge depreciation, etc. But till EBITDA, the largest item usually is COGS. Okay.
hmm,
Now, if you have to generate more CFO than your EBITDA, and also remember that CFO is after tax, EBITDA is pre-tax. Okay. So it is very difficult for a company to have greater than one ratio of CFO by EBITDA sustainably. Okay. It means that if your tax rate is 25%, you're consistently generating 25% more cash than your EBITDA. That's how your CFO will be, pre-tax CFO will be greater than your EBITDA by 1.25x, which will mean your post-tax CFO, which is the CFO number that we usually look at, that
hmm.
will be greater than 1. Yeah. So it's difficult, first of all. So that's why I'm saying that CFO by EBITDA greater than 1 is a golden business if it is consistently like that. So how can
So
it happen?
yeah, so I wanted to understand what is the characteristics of this business. Will they
Coming
have?
to it, coming to
Okay,
it,
okay,
coming
okay.
to it. So we have discussed one of these examples before. One example is, say, a hospital. Okay, so a hospital where most payments are happening in cash.
All
Okay,
right. Hmm,
so think of the power equation in a hospital. You are a patient, right? You are there probably because you're not well and you need immediate help. So the hospital has all the power in that dynamic. Yeah. So they extract cash very fast from the patient. Large hospital chains, they are able to negotiate very well with their suppliers and they're able to delay their payments. Yeah. Just like a normal manufacturing company, they can have 30 days to 60 days of payable days, whereas their receivables will practically be zero. If they have insurance sales, then yes, maybe 10 days, 15 days of insurance receivables. But whatever the cash sales, they collect immediately. Okay. And their inventory. So hospitals generally don't have too much inventory because a lot of their skill set is lying with people, right? Because the doctor does the operation. So yeah, you will need inventory, of course, of pharmaceuticals or your medical consumables, etc. But as a percentage of your balance sheet or as a percentage of your revenue, it may not be too high.
Right.
So these characteristics mean that your cash conversion cycle is deeply negative. You're collecting on the day that you are, doing the operation, and you're paying maybe 30 days later, net net. Yeah.
Got it. So it would be also, I mean, I can also think of it like negative working capital. So companies which have
Yeah.
a large negative working capital will
Yes.
fall into these kind of conditions.
Yes. So
Got it.
large negative. So there is a formula actually, Gaurav, from for deriving CFO from EBITDA. Okay.
Yeah,
So you can structurally go from EBITDA to CFO by subtracting three, four items. One of them is working capital. So
got it.
the more negative the working capital is, the higher your CFO will be.
Got it.
Yeah.
Okay, thanks.
Yeah. Okay, coming to the next point. Yeah, so this is very important, and this is what I already have explained this. So basically, suppose a company is showing great cash flows. Okay, so what happens if you're consistently generating cash? There is an item on the balance sheet called cash and cash equivalents. That item will keep getting increased, right? Every quarter, every year, etc., etc. So sometimes, in the case of Satyam, I'm sure all of you have heard of that Satyam scam. Excuse me, I have a little bit of a bad throat. Yeah, so in case of the Satyam scam, they had a lot of cash on the books, which was actually not real. Okay, and the auditor was going on certifying it. Yeah, because the auditor was also mixed up in the scam, and it was a big four auditor. Yeah. So how do you actually, as a individual retail investor or as an analyst, as a business analyst, how do you do a rough check कि ये cash सही में है या नहीं? Yeah, let's take an example. Okay, I was currently researching this company called Kaplan Point Laboratories. Okay, so इसी का example देखते हैं. So this is the annual report of Kaplan Point. Okay. So Kaplan Point manufactures pharmaceutical goods and it sells them in South American countries. So 90% of their revenues come from sales in South America, and 10% of their revenues come from sales to USA. Okay. So this is a cheap company. That's why I'm interested. But people in the past have said that this company has some governance issues. Okay. Some issues with respect to fraud, etc. So the first thing that comes to mind is, what is the kind of cash flow generation, and is the cash real or not? Okay, so the approach that I said is that you go to the balance sheet and check how much cash does the company have, and then you check the other income in the P&L statement and see if the interest earned on that cash, if that is making sense in terms of the interest rates that are existing. Okay, so we'll go to the balance sheet. Yeah, so this is the balance sheet. Yeah. So, Bhavna, can you look at the balance sheet and tell me how much cash is there?
Uh, 150.76 crores.
Correct. And is there any other item that is like cash?
Bank balances.
Correct. Bank balances. So usually, there will be three items which are related to cash. Okay. I mean, see, first of all, these are current assets. Yeah. So, Bhavna, what does a current asset mean? How is a current asset different from a non-current asset?
Um, so current assets, they are they get used up within 1 year usually.
Absolutely. That's the correct answer. You know the answer. You should answer more confidently. Yeah.
Yeah.
So you're absolutely right, Bhavna. So basically, these are all assets which will get used up within 1 year, less than 1 year, right? So there are usually three items: investments, cash and cash equivalents, and bank balances other than cash and cash equivalents. Okay. So bank balances other than cash and cash equivalents are usually, FDs, fixed deposits of maturity less than 1 year. Okay. You can have 3-month maturity, 6-month maturity, whatever. So company parks it in the balance in a FD of a small duration because it doesn't immediately need it, but it will need it maybe in less than 1 year. So it doesn't want to do a 2-year FD, 3-year FD. You know, the these investments which are non-current, they are more longer term. They could be in stocks, they could be in FDs with more than 1 year maturity, etc. Yeah. So we are only concerned with this cash and cash equivalents and bank balances. Okay. Investments may or may not be, interest generating. They may not, if they are stocks or something, they will not generate interest. So we will restrict ourselves to here. So how much is it? 450 or 462 crores. Yeah. What we'll do is we'll quickly go down and see the details. Yeah. So 10 and 11. Yeah. So number 10 and number 11. So let's go down. You have the details for each item below the notes. Yeah. So number 10 is here. Yeah. Number 10, cash and cash equivalents. Yeah. So Rishikesh, Kunal, can one of you help me for interest purposes? Okay. This is total is 150 crores. Can you read these items and tell me, is there anything that I have to remove from this 150 crores because it
Yes,
doesn't pay?
sir. I'm thinking of current accounts since they don't generate interest.
Absolutely right. Absolutely right. The current account will not pay interest. तो उसको निकाल दो. उसको निकालने के बाद you have about 75 crores left, right? 150 minus 75 is 75. ठीक है?
75.
And other bank balances में see the item, yeah? In bank deposit accounts maturity more than 3 months but less than 12 months.
12 months.
Yeah, so this is an FD account. So you will take the full amount, right? So 312 plus 75, about 387 crores. Okay. Now let us go back. Now we'll go to the profit and loss statement. Yeah. So in profit and loss statement, any other income, so revenue from operations, this is from selling pharmaceutical goods, anything else like interest cost or any interest income or anything else will be reported under other income. So item number 27. So let's go to item number 27 and see how much interest they earned. Yeah. So this is other income. Yeah. So can you guys, Kunal, can you tell me how much interest income they earned in 2022?
23.5.
Exactly, 23.5. And can you quickly do a calculation on 387 crores of deposits? If they earn 23.5, what is the rate of return for the year?
Around 6.5 percentage.
Yeah, it's around 6%, right? You just divide 23.5 by 387. So what does it look like to you guys that this company has cash actually?
Yeah.
Yeah,
Uh, since they are yielding around 6% on that amount.
that's a pretty good amount, right?
Yes.
Yeah. So basic check says that, okay, I mean, it's not like the cash is, just shown up as a made up figure. The interest is corroborating the amount of cash that is there in the balance sheet. Yeah. So this is the check that you need to do for every company when you're going into forensics. Yeah. So yeah. So this is basically the second point. Any questions on this?
No, no questions.
Cool. Kunal, Rishikesh, Gaurav, no questions, right?
No,
No.
sir.
No, no.
Okay, so let's proceed to the next point. So cash is done with. Okay, we've checked how to check cash. Next is related party transactions. Yeah, what are related party transactions? Related party transactions are basically any transactions that the company does with a related party. What is a related party? A related party can either be a company subsidiary, okay, or it can be a company owned by the promoter, or it can be a relative of what is called a KMP. KMP is a key management personnel. Okay, key management personnel can be promoter, it can be the chief financial officer, it can be another executive director of the company. Okay, so any transactions the company does with related parties is comes under related party transactions. Why is it important to analyze related party transactions, guys? As a forensic analyst, why would you want to analyze related party transactions?
So that they are not benefiting themselves or their like family members or something.
Correct. Correct. That's exactly why. Because there is a lot of asymmetry of information when you are a minority shareholder in a company, right? When you're a small retail shareholder, you probably know only 5% of what the promoter knows about the company. Because it's his own company, he works in it every day, he runs it, he controls everything. So he knows much more than you, right? And therefore he is in a position to take unfair advantage of that, right? By taking away money from the listed company and either benefiting his relatives or benefiting himself or benefiting other unlisted companies which he owns 100%, maybe. Yeah, it's often possible that the promoter will own only 20-30% of a publicly listed company, whereas he owns 100% of many small private companies. Yeah, because a public company has a large market cap, so he won't be able to own so much, because to grow the company he has raised equity from the market, so his share has got diluted, right? So related party transactions is that is the reason that it's extremely important to track these and to go through all the related party transactions and to see if there is anything shady or not. Yeah, if there is anything shady on quarterly con calls, or just we need to ask the question to management, or we need to write to management to clarify those. Yeah, so let's see what are the kind of things. So what is the total RPT to sales ratio? uh, so this is one way to check that whether there are too many related party transactions or not. So related party transactions are usually given in the annual report. One approach is to sum up the amount of all related party transactions, okay, and then divide it by the sales for the year to check what is the ratio. This number by itself cannot give you a yes no on whether a company is doing any hanky panky or not. This is just a number which can tell you, suppose Rishikesh, you are doing an analysis for a company, and I will later on review your analysis. So if you write that RPT by sales is greater than 100%, yeah, then
Okay.
I will automatically, when I'm reviewing it, I will automatically realize that this company is doing a lot of related party transactions and I need to be careful about this. So I will tell Rishikesh also to investigate further, and I will myself also investigate this entire thing further, right? So this is basically just a metric to check whether the number itself is too large or not. Another thing is, does the company have too many subsidiaries for no good reason? One way to confuse auditors and to confuse analysts is just to have too many subsidiaries. Yeah, so that it becomes very complicated to track. Where is cash coming? Where is it going? How is the equity of the company increasing? And sometimes what promoters will do is that they will have multiple listed companies with cross holdings. Like one company A will own company B will own company A, and then it's a nightmare, for an analyst to actually figure out whether money is being taken out of anywhere or not. So if a company is having too many subsidiaries, and your basic logic is not able to comprehend why do they need so many subsidiaries, you should pause and think and go deeper into it. That is one way that companies usually try to take out money, by giving loans to subsidiaries, investing in subsidiaries, and the subsidiary does nothing. subsidiary has no revenues, etc., etc. So in the annual report, one of the first things I do is I check how many subsidiaries does the company have, and for each subsidiary, I go and see when was the subsidiary founded, uh, what business does it do, first of all, then how much turnover did it do, how much profit did it do, etc., etc. So this is another check. Then,
Nirvan, one question.
yeah, Gaurav. Yeah.
Where do you check these things from Zoba or
No,
from
no,
the
no.
annual
So
report?
these are checked from the annual report.
Okay, got it.
This is completely available in the annual report. So every company has to declare what the broad results of a subsidiary were in a particular year, which means their revenue, their profit, how much equity do they have, that they have to declare in the annual report. And I think from the last 4 or 5 years, SEBI has made a rule where the company on their website, they have to upload the financial statement, the full financial statement, which means all the three financial statements of all subsidiaries, listed, unlisted, whatever, on their website. But that usually happens a little later, even after the annual report. So if you want to deep dive into a subsidiary, every company's website should have that detail. If they don't have that detail, you can actually write to their IR team, investor relations team, and ask for it.
Got it.
But
Uh,
yeah,
yeah, so if a company has say around 10% or 12%, 15% holding, say there are
yeah,
four companies, they together, or there are 10 companies, they each hold 10% each of a company, which they're
right,
using for these fraudulent activity.
right,
Guesswork. Okay.
yeah.
In those cases, we won't be able to get any idea because then they're not mandated to post these.
Yeah, I think you're right, Gaurav. That's a great question. I need to actually check this technically. So, just to give some more context to this discussion, if a company owns 50% or more than 50% of a subsidiary, then it becomes the subsidiary becomes important. Okay, so you cannot ignore that subsidiary or not talk about it in the annual report or not show its financial statements on your website. So these are called 100% ownership is called wholly owned subsidiary. Uh, any ownership between 50% to 100%, it's called a subsidiary. And anywhere where the ownership is less than 50%, it's called an associate company. Okay. Yeah, it's not a subsidiary, it's an associate company. So, uh, in an annual report, so we'll soon have a session on how to analyze annual reports. There, I'll cover this. So, you will always figure out who are the subsidiaries, who are the wholly owned subsidiaries, and who are the associate companies. So, you're right, Gaurav. For associate companies, they are probably not required to upload the full financial statements in their website, but they are still required to declare the broad financials, which is those 3 4 key metrics in the annual report.
Okay, got it.
Yeah. Okay. So now let's look at what are some problematic related party transactions. Yeah. So these are the things that you need to check. Has the company given any loan to promoters, or has the company taken any loan from promoter? Okay. How can this be misused, guys? Say the promoter is giving a loan to a company. Okay. Why do you need to be careful about this, or how can it be misused?
They can maybe charge high rates of interest as a way to get money from the company.
Absolutely. Absolutely right, Bhavna. So they can charge higher than the interest rate that a bank will charge the company. So in that case, if you figure out that the company's bank interest rate is 8% and promoter is given a loan for which the promoter is charging 10%, that is absolutely a red flag. Yeah. Next conference call or immediate email should go out to the company's management or company secretary asking what is going on. Yeah. Same thing with loans to or from related parties. Rent paid to promoters or key management personnel. This is, one very common factor you will see in Indian companies. And this is very common because, see, a lot of Indian companies are promoter driven, right? That some guy had a normal business, unlisted business. He was able to grow it. And then he decided, I will list in the stock market. So sometimes even the headquarters of the company can be actually a building owned by the promoter, which he later, he let the company use it as the headquarters, but it's actually his property. So there are definitely genuine reasons for promoters, collecting rent from companies, but this is again a potential area of leakage. So the rent can be much higher than market rate. So you need to be careful. If you have like 40 employees or 100 employees, then you know the kind of office you would have, right? If you're an IT company having 100 employees, you know the kind of area you would need, kind of real estate you would need. So if the company is booking 50 crores as rent every year, that's not something that you can reconcile, right? And if the rent is especially going to the promoter or to a related party or something, so these are things you need to be careful about. Yeah. Then transactions with other promoter owned companies, this is also very common. What will happen is, suppose a company, listed company A is there. There is an unlisted company B, which the promoter owns 100%, and B will supply raw materials. B will become A's supplier, okay, or B will become A's customer. So either on the supply side or on the customer side, and then these kind of transactions can be problematic. So if you have a lot of related party transactions between the listed company and the promoter owned company, there was an example where there's a company called SKM Eggs. Okay. So this company is basically into the business of exporting eggs and egg products from India to abroad. Okay. And the promoter had an unlisted company which was into marketing eggs in the domestic market. So selling eggs basically when you go to a shop to buy eggs. So he ran a brand by the name of I think SKM only, but that was not part of the main company, the listed company. That was a separate entity, 100% owned by the promoter. So the listed company used to give eggs for cheap to this guy, to the other company, and that company would mark it up and sell it in the market. Okay. So all the profits from the retail operations were actually accruing to the subsidiary. So these kind of things are also problematic. So if you see too many transactions between a promoter owned company and a listed company, your antenna should automatically go up. Okay. And then you need to check what is the ratio of KMP remuneration to PAT. Okay. So here there is a guideline issued by SEBI saying that we recommend that the payment made to all key management personnel should be less than, I think, 13% of PAT per year. Okay. But it's a recommendation. SEBI doesn't say that you are not allowed to pay more. So usually companies which take 20% of PAT as salary in bad years also, yeah, usually that is considered to be minority shareholder unfriendly. That is, it is not a corporate governance red flag, but it gives a feeling that the promoter does not care so much about minority shareholders. Even in a bad year, the promoter is happy to eat away 20-30% of PAT for their own salaries. So that is another thing that guys need to check always, that what is the total KMP remuneration divided by PAT. There will be some companies where the promoter will forego a salary for a year because the business is done poorly. So say normally his salary is 1.5 crores, he will not take a salary in a particular year because the profits have been very low, the business had a bad year. Yeah. So that's usually a good sign. It's a sign that the promoter thinks long term and that the promoter care about its shareholders. Yeah. Okay. So I think that's it for related party transactions. Any questions?
No, nothing from my side.
Cool. So we move to the next part, which is assets on the balance sheet. Yeah. So on the balance sheet, some things you need to check is, uh, do you guys know depreciation? Kunal, do you know what depreciation is?
Yes.
Can you just simply explain it?
When the assets get old
Hmm.
due to wear and tear,
Right.
it depreciates its value.
Correct. That's right. So basically, if you are buying, refined oil to make chapatis at home, uh, you will pay the amount to the shopkeeper and you will open the can and you will finish the can, right? So you consume the refined oil probably in a small span of time, right? But when you're buying say a Xerox machine or a printer or something, you will use that over multiple years, right? So uh, in or similarly, when a company buys a big machine or sets up a large plant, it will use it for 10 years, 20 years, things like that. So depreciation is basically a way to make sure that the amount that the company pays to either set up a plant or to buy a machine, it is able to split it equally over the life of the machine. So every year, the cost booked on the profit and loss statement for the machine will be equal to the cost of acquisition of the machine divided by the number of years that the machine will be in use. Yeah. So it's a way to spread out the cost of acquisition. Okay. So, there are some guidelines issued by the Indian auditing standards, Ind AS, that a plant can depreciate in 10 years or 20 years. A computer can depreciate in 5 years. You cannot depreciate a computer in 10 years. There are some rules here, accounting rules that a company has to follow. Okay. Uh, so one, fraud check or forensic check that you can do is the depreciation rate consistent over years? So which is the depreciation rate is basically this ratio: depreciation divided by fixed assets plus current capital works in progress. Yeah. What is capital works in progress? It is money which has been invested towards setting up a factory or buying machines, but the entire factory or machine is not ready yet. It is the work is going on in it. So money has been invested, but the asset is not a finished product. So that is called capital work in progress. So depreciation divided by fixed asset plus capital work in progress is your depreciation rate, right? The denominator is the amount of fixed assets you have, and the numerator is how much of that fixed asset is getting depreciated in a particular year. So this ratio should normally, not change too much. It should be in an acceptable range. Okay. uh, unless the company is buying lots of different kinds of assets which have different lives. So suppose its main business, the assets had a life of 20 years. It is now entering a new business where the assets have a life of 10 years, and it is investing aggressively to buy fixed assets in for that new business. Then this rate can change. But if the business is in the same area and it's continuing year after year, this depreciation rate should not change. Yeah. uh, Sometimes companies try to manipulate the life of a machine or life of a factory. They make it go up, they make it come down to change this depreciation rate. Why would a company do that? Can you think of a reason?
To manipulate profits.
How?
So if they are charging more years in depreciation, so the expense would be reduced and profit would be mm, higher in that case.
Absolutely. Absolutely. That's exactly the correct reason, Rishikesh. So the company can arbitrarily increase the life of an asset, and therefore reduce the amount of depreciation charged to the P&L and increase its profits. Sometimes, in a great year where there's a lot of profits, the company doesn't want to show so much profits, because every time a profit is recorded, the market expects you to beat that number next year, right? Because we are all crazy about tracking YOY profit growth, QOQ profit growth, etc., etc. I actually know of companies which will sometimes intentionally, hide some profit. So one way of hiding it could be depreciate arbitrarily, decrease the life of a machine or something, so that you charge a higher depreciation for a particular year, yeah, and reduce the profit artificially. This doesn't happen much, but still, like, it is a possibility you should consider. Mostly, it is a case of reducing the depreciation cost by increasing the life of the asset. So
So
this is
also,
another check. Yeah, go
one question also, if I increase the depreciation,
ahead.
doesn't it reduce the taxable income?
If you increase the depreciation, it does reduce the taxable income.
I
Yes,
got it. Okay.
because your
So,
your profits are decreasing and you pay
mm,
tax only on the profit.
So basically, a company who's increasing the depreciation can also save taxes or avoid or just,
Absolutely.
I mean, that's a fraudulent way of not
It's a
paying tax.
fraudulent way of not paying taxes. Very good point, Gaurav. Yeah. This also companies can, often do, because
Um,
depreciation is a non-cash expense, but taxes are a cash, outflow.
mm, mm.
So
Then
yeah.
also if a company is doing some hanky panky with depreciation, they will also do random write-offs at some points of time, isn't
Yeah,
it?
yeah. That's very possible. So that's why the 400 crore write-off by Tanla, which we were discussing yesterday, that was problematic. Maybe it was genuine,
Hmm.
but the market doesn't see it that way. Yeah, the market
Okay.
expects you to recognize that the asset is becoming obsolete and declare in advance, and not give a nasty surprise all in once, where
Hmm.
your normal depreciation is 20 crore, and suddenly one day you come and say, in this quarter I write off 400 crores, right?
Hmm.
So you're absolutely right. So companies can be, may want to write off assets from time to time, because if you write off your assets, also you're able to show a higher ROC, right?
Yes.
Because your asset side decreases, and you know that profits are going to come from uh, other assets or intangible assets. So your ROE, ROC improves.
Got it. My last question is this depreciation by fixed asset divide and current work in progress. So the
Mhm.
current work in progress, does that come under, I mean, does that also get depreciated? So this is
No, no,
not
no.
clear to me.
No, that doesn't get depreciated, but it's part of your basically your asset base.
Huh.
So there's a reason that I had included the CWIP. You can actually take the fixed assets also in the denominator. I had thought of a reason for including the CWIP, because what happens is, suppose in a particular year you have invested, and that money has not converted into a machine. uh, okay, I need to think about this, Gaurav. That's a good point. I think you can go ahead with depreciation by fixed
Hmm.
asset also.
Hmm.
I think, there's some reason that I had decided to include the
Uh,
CWIP.
The
I'll get back.
CWIP, I also wanted to understand CWIP a bit deeper. So basically, say our Gujarat Fluoro. Now
Yeah,
they want to set up a lithium
right,
electrolyte plant, right?
right,
Say
right,
2024 they got an approval, and there's a huge demand,
right,
super huge demand. So now they purchase land, they purchase the all of these things, and they start building the factory. So
right,
on 2024 end of the year, say December, they do it, and they estimate that this plant will be complete by 2027 when it
right,
would start producing.
right.
So my CWIP would be that, I mean, incremental money that is spent quarter by quarter
Yeah,
till
so
20.
yeah, correct. From 2024 to 2027, whatever
Hmm.
money you're putting,
Hmm.
it'll all start piling up in CWIP. So when it transitions from CWIP to fixed asset is when the asset is ready to generate revenues.
The asset is ready to generate revenues. Okay. Yeah.
Yes.
Yeah. Yeah.
So when the asset is ready to perform the function that it is intended to perform,
Hmm.
only then it gets converted into asset. Till that time, it'll stay in CWIP.
Okay. Got it. My another question is, so in the for the tax purpose,
Mhm.
if I have some CWIP, does that get tax benefit, or that is?
No, because it's not an expense, no, it's an
Hmm.
investment. So
Got it.
your tax is determined only by the profit and loss statement.
Got it.
Okay, it has nothing to do. This is a balance sheet item. It doesn't
Hmm.
enter the profit and loss anywhere. It's just a asset creation.
Got it. No, so I was trying to kind of wrap my head around, if a company has, say, debt versus a company has uh, equity, which one they should use for creating assets. What is the more logical way of doing it? Say, for example, they can generate, say, 15-20% uh,
Hmm, hmm,
from their business, and they can raise money at 10%,
hmm.
and they have enough cash left, they also can raise debt. Which one would be more prudent for a company to do?
Yeah, so this goes into the concept of, cost of capital for a project. So normally, Gaurav, every company will, for a large capex to build factories, etc., they will use a mix of equity and debt. Yeah,
Hmm.
so it
Hmm.
depends on the capital position of the company also. If its balance sheet is already quite stressed, it will try to minimize the amount of debt that it will use for the new project. Yeah,
Okay.
or it will raise some equity through a rights issue, or through a QIP before it embarks into this capital expenditure, because bankruptcy risks will otherwise increase if it keeps on funding new projects using debt when it already has a lot of debt.
But
But for yeah.
One question. But if a company, if their balance sheet is very strong, they have enough cash
Hmm,
over there,
hmm.
but still they take debt, wouldn't that debt, I mean, whatever money they are using for building the asset, they can interest expense it out, whereas for the equity part of investing they can't expense it out, isn't it?
Expense it out in the sense, how do you
Yeah,
mean?
I mean in EBIT, EBIT. So
Hmm,
in the first case where the company with a good balance sheet, they can
hmm.
expense out, or they are I mean they're making their EBITDA. From there they're subtracting their interest, and then they're giving their depreciation, amortization, and then they're doing the taxes. Paying
Right,
the taxes, right?
right,
Whereas if you would have done it with your own accrual, then you wouldn't be
right.
paying their interest, isn't
Right,
it?
right. So which is why the cost of debt, suppose you're getting a loan at 10%. Okay.
Hmm. Hmm.
There is a similar concept called cost of equity, which
Hmm.
means to raise equity. Suppose you're raising equity, that's not free. Okay. If you're raising equity from people like me or from big institutional investors, they have a return expectation. Okay.
Hmm. Hmm.
That is called your cost of equity, which is usually equal to the return on equity. So that is something like, say, 15% for a company. Okay.
Hmm.
And the cost of debt is 10%.
Hmm.
But the effective cost of debt for a company is 10% into 1 minus tax rate, because the tax reduces your interest burden, right?
Okay.
Because you subtract interest from your profit and your profit, so the tax that you pay out on your profits reduces by the amount of interest, right?
Hmm. Hmm.
So the effective cost of debt is actually 7%. It's
Hmm.
not 10%.
Correct. So you are able to raise money at a much cheaper with
Correct.
respect to, and if you're not even raising equity, say for example, you're just you
Using
have
cash.
you have
Using
cash in
cash.
your balance sheet. You have
Yeah,
cash
yeah,
in your balance sheet. You
yeah,
have substantial investments. You're not breaking those investments, but
yeah,
just taking debt and building your whatever you need to build, and then from next year onwards you pay up those debt.
yeah. So if your
So
if your balance sheet is not stressed, it makes a lot
hmm,
of sense to use debt.
got it.
Um, if your balance sheet is very stressed, then the
Then
risk
so
of
it's a different question.
yeah, the
Hmm.
risk of bankruptcy is too much, and
Hmm.
the market will actually beat down your stock's value even more.
All
So,
right.
so in that case, you should not use. But otherwise, it perfectly makes sense. Very few promoters, for example, Kaplan Point is one example where the promoter hates debt. Okay, because in his earlier venture in the late 1980s, the guy had taken a lot of debt, and then he had to leave the country because he was bankrupt, and he
Okay.
had to go and take refuge in Angola or something. So as a result of which, the guy hates debt. Okay, so
Got
these
it.
are these are the stories behind promoters and the way a business is structured. So he will never take debt. He set up an injectables factory for USA at about 100 crores. He funded all of that through internal cash accruals. But
Got it.
that is actually, like you rightly pointed out, it's not the best way in terms of cost of capital.
Yeah, good capital allotment. I mean,
Yeah, it's
good
not great
capital
capital
allocation.
allocation. Correct. Yeah.
Correct. Great.
Right.
Okay. Yeah, please continue. Thanks.
Yeah. So, apart from that, another thing that is very important to check is what percentage of balance sheet assets are intangible assets. Okay. So let me show you guys an example. Uh, what are intangible assets? Can anybody say?
Goodwill.
like goodwill and
Okay. Goodwill is more complicated, a simpler intangible asset. Or what is an intangible asset? Like, can you describe it?
it gives benefit to the company, but it cannot be touched or seen.
Correct. It's not a physical asset.
Yes.
Absolutely. So it's not a physical asset. So apart from goodwill, can you think of anything like that, Kunal?
Patents.
Absolutely. Great answer, Bhavna. So patents, right?
Yes.
Because if you have a patent, you can get benefit out of that because you will get exclusive right to manufacture that product and earn profits. Okay. Another example is customer relationships or customer details, customer contacts. So that is sometimes treated as an intangible asset. Then you have software which is developed in-house, right? So Microsoft is developing a new software. That is an intangible asset, that can be capitalized and depreciated. So when an intangible asset is depreciated, it's called amortization. It's not called depreciation. Both are essentially the same, but depreciation applies to physical assets and amortization applies to non-physical or intangible assets. Yeah. So I have opened the page for Tata Consumer Products. Yeah. This is an FMCG company. The company has grown mostly by acquiring other brands. Okay. So let's go to their balance sheet and look at fixed assets. Okay, let's expand this. Total fixed assets are 12,600, or let's look at the gross block. The gross block is 15,000. Look at the amount of intangible assets. 11,000. Almost all the asset is made of intangibles, yeah, which means they've probably kept on acquiring, and a lot of goodwill has come up on the balance sheet. Uh, Plant machinery is only 2,200, 2,300. Okay. So now goodwill, we are hearing this term, right? So what is goodwill? Does anybody know what goodwill is? Okay. So this one is tricky.
Shall
If
I
you,
try to explain?
yeah, please go ahead.
So basically, if I am a company and you have a company, and we are probably one and I want to purchase you.
Yeah,
Maybe I want to purchase your company for strategic reasons, but
right,
you won't sell me your company at your book value. You would
right.
probably also want some premium on it.
Absolutely.
So if I purchase your company and then I take your book value and add it to my balance sheet, there would be a disbalance, and that disbalance would be that extra money that I paid goes into that goodwill.
Absolutely, absolutely. Perfect definition, Gaurav. So basically, guys, did you understand that? So every company on the balance sheet, this is the balance sheet, right? So this is the liability side, this is the asset side, right? So the net worth of a company is the sum of these two items, right? Share capital and reserves. It is basically total assets minus total liabilities. Liabilities are what? Borrowings and other liabilities. So if you subtract 20,811 से अगर तुम ये दोनों को subtract कर दोगे तो जो बचेगा वो है equity, right? So suppose somebody wants to purchase this company. Okay. Now this company won't. This is the book value of equity. This company won't be sold at this, whatever, 14,900 crores. It will say cost the other company 30,000 crores to buy this. Yeah, because companies rarely sell at book value, right? Because there's a lot of value to the employees that you're taking over, to the patents, etc., that you're taking over, and those patents, etc., are not on fair value on your balance sheet, right? They are only at the book value recorded at the cost that was put in to make them, right? But the value you can generate from them might be much higher than the cost. So the 30,000 that you pay versus the 15,000 the asset values are recorded at, that difference of 15,000 is booked into the acquiring company's balance sheet as goodwill. Okay. Did you guys understand this? Bhavna, Rishikesh, Kunal, or should
Rishikesh
I
dropped off.
explain again? Oh,
Rishikesh
Rishikesh
dropped
dropped
off.
off.
I think some internet issue.
Yeah, maybe. Bhavna, Kunal, did you guys understand this?
Yes.
Yes.
Yeah. Okay, great. So that's how goodwill builds up on a company's balance sheet. When it makes acquisitions and pays for the acquiring company more than its book value, then the balance is captured as goodwill. So why should you be careful of goodwill? If there is too much goodwill on the balance sheet, why have I mentioned this as a problematic point or a point that you guys should be aware of? Can you try and answer this? If suppose a balance sheet is there and 80% of the balance sheet is only goodwill, why should we be careful about it?
There's a great company, Quest Corp,
Hmm.
for this one.
Oh, okay. They have a lot of goodwill, is it?
Yeah, they have a lot of goodwill and they did a lot of things with that goodwill.
I see. I see.
I'm waiting for them to answer. Maybe Bhavna or Kunal, if you know.
Yeah.
If not, maybe
Yeah.
yeah.
Go ahead. Go ahead, Gaurav.
So basically, lots of time, companies who so for example, as I told you, I'm acquiring Nirvan's company. Now I'm telling the market that I'm acquiring it for strategic reasons, but Nirvan and me, we are friends, right? And because we are friends, what happens is I'm actually overpaying him, knowing that he'll give me some kickback, he'll give me some money off the table. So instead of giving 100 crore to his company, which could be the fair value, I give him 1000 crore. Now that extra 900 crore is sitting on my goodwill, and it's probably a large amount. What would I do is, in the first year, say the retail investor who are not going very deep into it, they are saying such assets are I mean, this company is so strong, they're buying companies, they're buying their strategic competitors, their asset value is increasing, etc., etc. One fine morning, what would I do is I will write off some of those goodwills, and then the share price would just fall substantially. So I do two things with goodwill. One, I can do all hanky panky stuff. Second, a large amount of inflated goodwill is like gas sitting on your balance sheet, which can collapse anytime because there's nothing really backing it up.
Yeah,
Yeah.
absolutely. Absolutely. Great example. So basically, see, there is no, if you have an asset like a factory or a machine, you can ascribe a value to it, right? You can trust it. When you're acquiring another company and booking a lot of goodwill, like Gaurav said in this example, there's a lot of scope for manipulation because goodwill is actually, people like us, people with lots of wearing suits, etc., sitting in a room. They are trying to value the target company, and then they are trying to ascribe a value to it, and then whatever is the difference with the book value is getting recorded as goodwill, right? Now they can go wrong in their calculation, their assumptions may go wrong, or they can do outright fraud like the example that Gaurav gave, right? So that goodwill value is very tough to trust, and often companies will once a year they are required to basically check whether the goodwill is intact or not. If the goodwill is not intact, they are required to write it down. So one morning you can get a nasty surprise from a company like Tata Consumer that because this brand is no longer doing so well, we have written down the goodwill by XX amount. Tata Consumer is a Tata Group company, so I don't expect this to happen, but it's just an example for a company with a large amount of goodwill. Yeah. So it's always important to check what percentage of my fixed assets, not even total balance sheet assets, just check what percentage of my fixed assets are intangible assets, or and then in intangible assets how much of them are goodwill. To see that, you can't see that on screener, you have to go to the balance sheet in the annual report, and actually there you will get a split of all the intangible assets, right? Is Rishikesh back, Gaurav?
Yes.
Okay, great. So I think I'll take 5-10 minutes more. I know it's already 1 hour, guys. Please bear with me. I want to finish this today. I'll wrap it up in 10 more minutes so that we complete the session here. Okay, and some miscellaneous checks. Okay, this I wasn't able to group in exactly one header. So miscellaneous checks. Fraud revenue check. Our account receivables growing at 80%, whereas sales are growing at 30%. Yeah. So if sales are growing every year at 30%, account receivable should be growing at what rate logically? Kunal, Bhavna, either of you? If sales are growing at 30%, account receivable should be growing at
30 only.
30 only. I mean, logically, it should. There's no reason for you to suddenly extend more credit to new consumers, right? Or less credit to new consumers. Logic says that it should more or less be in the ballpark. Now, exactly same will never happen, but there should be no reason for it to change significantly, right? But if your receivables are growing much faster than your sales, what does it mean? It can mean either one of two things. Either you are in your desperation doing what that panwala was doing, is you're just selling things without caring about how the money will come back to you. That's just poor sales quality. Yeah. Or second, you're outright doing fraud, where you're billing to some fraudulent company that doesn't even exist. The goods are lying in your factory only. You're not even moving the goods out. You're just recording fraudulent sales, and that year will pass, and 2 years later you will say there were some defects, and you will take back those revenues. Yeah, you will say these are goods returns, or whatever. So this is an extremely one of the most important forensic checks. How fast are receivables growing compared to growth in sales? Yeah, this can also be seen if the receivable days are going up very high, right? You can either check the growth rate of account receivables, or you can check the receivable days. If the receivable days are really going high, it means there's a chance of fraudulent revenues, or irresponsible sales happening. Yeah. Okay, what is the ratio of total contingent liability to net worth? This is another extremely important check. Kunal, Bhavna, actually Bhavna, I think we have discussed this before. So Kunal, do you know what a contingent liability is?
No, I don't.
Okay, no worries. Rishikesh, do you know?
Yes, it is liability which will arise on particular condition if something happens. Like if there is case going on, if they lose the case, then they have to pay something or something
Absolutely.
like that.
Absolutely. Great answer. So basically, contingent liability means liability which is contingent on something happening, Kunal and Bhavna. So it means that if suppose there's a court case going on, okay, and if the company loses the court case, it has to pay 100 crore in damages. Yeah. So how will the company account for that? There's no way for the company to put it somewhere in your balance sheet or something, right? So it's a contingent liability, which means that if things go wrong, the company's profit will decrease by 100 crores because it has to pay that amount. Yeah. Or income tax cases keep going on. So it's usually related to do with court cases. Okay. Contingent liabilities are related to do with court cases. For banks, there's a different kind of contingent liability. They fund what are called bank guarantees for a lot of companies. So if that bank guarantee fails, then sometimes a contingent liability will hit a bank. Yeah. So sometimes companies, what they will do is, if they're expecting to lose a court case, okay, it's a contingent liability, but they're expecting to lose it, they will create a provision in their balance sheet. Say, as a potential loss of 100 crores, they will create a provision for 70 crores, and they will take the P&L hit in that year itself, because they are saying to investors, boss, ho bhi sakta hai, so we want to be extra careful. We'll take the hit now, and later on, if we win the case, we'll reverse it. So in that year, you will get an extra 70 crore profit. That is good management and good kind of accounting behavior. Otherwise, another company will not bother to provision it, and one fine day it will send a nice announcement to BSE, NSE. Rishikesh will wake up expecting his stock to double. Suddenly one day the company will announce saying 300 crore घुस गया कहीं पे. Contingent liability था, हमने केस हार गए हम, अब 300 करोड़ चला जाएगा. उसका इक्विटी 1000 करोड़ था, वो 700 करोड़ का इक्विटी हो गया, स्टॉक हाफ हो गया. Right? So as an analyst, one of the things you need to check is एनुअल रिपोर्ट में जाइए, चेक करिए कि टोटल कंटिंजेंट लायबिलिटी कितना है. देयर इज अ सेक्शन ऑन कंटिंजेंट लायबिलिटी इन द एनुअल रिपोर्ट. यू कैन जस्ट कंट्रोल F contingent liability and go through some of the times it appears. You will get to a table which gives all the contingent liability details. Sum up the contingent liability, read about the contingent liability, sum it up, and then divide by the net worth of the company, which is the total equity that the company has. Book value multiplied by number of shares outstanding. If the ratio is too high, what do you mean by too high? For me, anything greater than 10% is too high. I mean, of course, 90% is much worse than 15%, but still, if it's greater than 10%, I am going to be a little alert. If it's 20-25%, I'm a little worried. Yeah. And if the company has other signs of poor governance, I'm really worried. So this is a very important ratio. Yeah. Then another thing you need to check is other expenses. Other expenses is a nice account on P&L where management can dump anything and everything. Okay. So you need to be careful of what percentage of revenues is that other expenses going. Is there a huge deviation from last year or from last quarter or from the usual trend? Or is the other expenses percentage for this company very different compared to other companies in this industry? So then you need to go through each item in the other expenses. There's a laundry list of items that will be there. In you can again go to the annual report, just control F other expenses. You will come to a table where there'll be at least 15 to 20 items. Power costs, auditor fees, freight, travel expenses, um, then legal fees. Okay, you will have a laundry list of items. Sometimes a company will very quietly write something off and very quietly nicely put it in other expenses so that you won't even notice. Yeah. But if you're a sharp analyst, if you know your forensic accounting, you will always go through the other expenses to check the items that are there. Yeah. Okay, capital prudence is history of too much equity dilution. Yeah. So sometimes what happens is when we are looking at companies on screener, what we do is we look at a table like this: compounded profit growth. We see, okay, 10 years, 11% profit growth. Great. The company is a consistent compounder. It will make money. Yeah. But we forget to see whether the company is also increasing the number of shares outstanding by 10%. In that case, your ownership value in the company actually doesn't go up, right? Because you're getting diluted every time, right? So the company keeps issuing new shares or ESOPs in such quantities that your ownership in the company dilutes, and the earning per share or the net worth per share, the book value, actually hasn't increased at 10 years. Then, then you're not making any money. Yeah. So dilution is something, especially with IT companies, which have a lot of ESOP costs. Especially in the US, this is a big problem. So they issue obscene amounts of ESOPs, and retail investors keep getting diluted. Everybody gets diluted actually. Yeah. And the last point, this is one point which I am increasingly realizing is very important to judge a company. So if the company generates great cash, it's a business where it's a cash cow business, where there is not a lot of new capital investment required. The market is pretty settled, no new competitors. So the company generates great amounts of cash, but it is not doing anything with that cash. It is not paying it out to shareholders as dividends. It is not doing share buybacks. It is not even investing it in new business sources. It is just keeping the cash on the balance sheet. That is a big red flag. It may not be a fraud or corporate governance red flag, but it's a red flag in terms of either the management has no idea, how to grow the company, or the management doesn't want to return cash to shareholders. Because ideally, if the company has no growth avenues, the company should be returning all that cash generated as dividends or share buybacks, right? So the company is not minority investor friendly if it is not returning that cash and at the same time not entering new areas of business. Yeah. So I'll show you one example. This is actually a company I like a lot, but lately I'm having, this company is called Sharda Motors. It is an auto ancillary company. So you will see in the balance sheet that cash has started piling up. See, cash has started piling up, and now from 60 crores in 2017, just 6 years ago, it is now at almost 500 crores of cash. And the company, what it makes? It makes emission systems, which means the exhaust systems that you see in cars, it makes those, right? So the company has a big threat of getting replaced by electric vehicles. So the company needs to invest in other areas. It is not as if the company is very comfortable and the industry is going to continue for 20 years. So even if it has cash in the balance sheet, it is okay. It is a question about the survival of the company, because the exhaust system business may not go on for 30, 40 years, or it may go on, but it may stop growing. So this kind of a company needs to deploy its cash, but so far it is not. Every quarter it comes on the call and says that we will deploy, but it still hasn't done it. Yeah. So this is, and it doesn't increase the dividend. So if you see, last year they paid only 16% of the profits as dividend. Yeah. Before that, for 3 years, no dividends. Before that, some 20%, 25% of dividends. Yeah. So this is a red flag for me. If
One
this
question: have they converted this cash into, say, FDs on all, or they have just put it in the bank
No,
line?
they've kept it in FDs, Gaurav. So they
Hmm.
won't keep it in current account. I mean, they will earn some interest on it,
Hmm.
but
Right.
I mean, their ROE is some 20%. Okay. Even if they enter a new business, they'll earn at least 12-13%, versus that they're earning 3-4% on that
Okay.
cash. Yeah.
No, I'm trying to interpret it because the business dynamics and all. Is the company foreseeing some big investment which they don't want to
Yeah,
say?
yeah. So the company is saying that they're exploring, acquisitions in a couple of areas in the automotive space.
Hmm.
So that's what they're saying, and investors have always been believing them. They are actually very good promoters, yeah, and very conservative. So investors can understand that it takes time for a company to evaluate the right opportunity. You want to pay the right amount of money to acquire a company. So all that is perfectly fine. But it's been now going on for 4 5 quarters. So it's at the back of my mind now. Earlier, Sharda was never like a concern for me. But
Hmm.
I'm just illustrating with an example that, if this keeps repeating a pattern, no matter how much you love the company, you have to start, trying
Trimming.
to figure out if there's something wrong or not.
Yeah, yeah.
Yeah. I hope there's nothing wrong and they actually, complete an investment soon. But yeah, so
Great.
that's it. So, guys, that's the presentation. I'll share this presentation on Motion, and Gaurav will upload the recordings maybe in a day or two. So, Rishikesh and Kunal, go through the first presentation so that you have the complete picture for forensics. Yeah. And Gaurav, next week or maybe this weekend,